Welcome back to The Explainer. I am genuinely thrilled you're tuning in today because we are about to dive into a strategy that literally flips conventional trading advice right on its head. If you've ever felt like the age-old financial wisdom just kind of isn't working for your day-to-day active trading, well, you are in exactly the right place. Today, we're breaking down a highly structured, totally counterintuitive system we're calling the Surfer's Playbook. It's a momentum trading strategy that ignores the fundamentals entirely and instead capitalizes purely on supply, demand, and explosive real-time news. So get ready, because we're going to completely rethink how we look at the market.
Okay, let's dive into this. We're really looking at a tale of two entirely different mindsets here. On the left, we've got the legendary Warren Buffett approach, right? Value investing. Buy the dip. Be greedy when others are fearful. And hey, that's fantastic if you want to buy Coca-Cola and hold it for 15 years based on its actual underlying value. But over on the right, we have momentum trading. And the mantra here is wild. It's buy the high. Why on earth would you do that? Well, because you've probably heard the stat that 90% of day traders lose money. And if 90% of people are bleeding cash trying to buy the dip on intraday moves, maybe it's time to try something completely different. We are not investing for value here, folks. We are trading for momentum.
So here's our roadmap for this explainer. We're breaking this down into 4 quick parts. First, a counterintuitive strategy. Second, the 3 core rules. Third, the surfer's exit strategy. And finally, the math of profitability.
All right, kicking things off with Section 1, a counterintuitive strategy, and exactly why buying the high actually works. You see, trying to find long-term value in heavily shorted, frankly terrible companies is a losing game. Instead, we have to rely purely on a mechanical reaction to price action.
And that mechanical reaction relies on a super simple 2-step engine. Step 1, you buy the 1-minute candle that closes at the current high of the day. You are literally buying at the absolute peak. Step 2, you sell the very first candle that closes below the low of the previous candle. And that's it. That's the entire core mechanism. But, and I really need you to hear this loud and clear, if you just log into your brokerage right now and blindly start buying every single high of day candle using only this 2-step engine, you will absolutely lose your shirt. This engine is completely useless without the proper context to run it in. Let's move right along to see how this builds in Section 2, the 3 core rules, which is really all about setting the stage for success. Okay, so rule number 1 is all about timing. We only ever trade on a 1-minute chart, and we only execute this strategy during extended market hours. So that means the pre-market window from 7 a.m. to 9:30 a.m. Eastern, or the after-hours window from 4 p.m. to 8 p.m. Eastern. Now, why is that absolutely crucial? Because extended trading hours are almost exclusively when companies drop their major news announcements. We're talking things like letters of intent to acquire, or massive earnings jumps that feature real tangible dollar amounts in the headlines. We need those specific timeframes because that is when the catalysts actually strike. Which brings us perfectly to rule number 2, the catalyst. We are specifically targeting the immediate reaction to real-time news. News is news. We all get it and react to it at the exact same time. The instant a headline drops, the playing field is completely leveled. It seriously doesn't matter if you're a retail trader in your living room in pajamas or a floor trader at a massive hedge fund. For that brief initial window, everybody is seeing the exact same info and reacting simultaneously. This is that pure, unfiltered rush of volume that we want to capitalize on.
But, and this is a big but, you've really got to be aware of what happens next. The source material warns heavily against trading the secondary move. See, just a couple of minutes after that initial news rush, the big money funds step in, and the manipulation begins. They start bouncing the stock around specific liquidity levels just to get their own exits out. The source actually refers to this as institutional fudging. Think about the S&P 500 when an interest rate announcement drops right at 2:00 p.m. You get this massive, clean initial reaction spike. But look at the chart right after that. It's just lower volume, choppy, heavily manipulated price action. We want the initial rush, not the fudging.
And finally, we have rule number 3, the supply. The stock absolutely must have a low float. Now, float is simply the overall supply of shares available to be traded out there on the open market. For this playbook, we're looking for stocks with a float of under 50 million shares. It comes down to basic high school economics, really, supply and demand. When you have a very low supply of shares and you suddenly inject a massive, heavy influx of demand, which, remember, comes from the volume generated by that real-time news catalyst we just talked about, you create intense, explosive volatility. And as active momentum traders, volatility is the name of the game. It's exactly what we're hunting for. And this brilliantly illustrates exactly why float size matters so much. Let's compare two real examples right from the source data. On the top, we've got Xerox, ticker XRX. They dropped earnings news, but they have a massive float of 120 million shares. Now, the stock moved up a respectable 28%, sure, but it took an entire hour to do it. Now, look down at the bottom row. Ticker VRAX. They dropped news, but they are a micro float company with less than 1 million shares available. Look at that reaction, a 90% upward move in just 3 minutes. That is the explosive, rapid volatility we are chasing. We don't want to sit around for an hour for 28% when a microfloat can deliver 90% before you've even finished your morning coffee.
All right, moving on to Section 3, the surfer's exit strategy. Getting into a trade is really only half the battle. Let's talk about actually riding the wave of momentum. I absolutely love the metaphor used in our source material here, the momentum surfer. Just think about how a real surfer behaves out on the water. Do they paddle out into the middle of a perfectly flat ocean, stand up on their board, and just kind of hope a wave magically appears? No, that would be ridiculous. As a trader, a flat ocean means there is zero news. Don't just sit there in stagnant stocks. You wait for the wave to form, and that wave is your real-time news catalyst. Once it forms, you jump on by buying that initial reaction. And then, crucially, you ride it. You hold on to that trade until the momentum physically breaks down.
And here is where so many beginners completely sabotage themselves. They jump off in the middle of a perfect wave. Imagine getting into one of these microflow trades right at the news drop. Within 60 seconds, you're up 15%. It's incredibly tempting to lock in that profit, pat yourself on the back, and say, wow, I just made 15% in 1 minute. I'm a genius. But by doing that, you're abandoning a trade that was fundamentally set up to run 80% or more. You're taking your profits way too early, which completely destroys the underlying math of this strategy, as we're going to see in just a sec.
So, how do we actually stop ourselves from jumping off too early? Well, we go right back to that mechanical step 2 from the very beginning. You only exit when a candle closes below the low of the previous candle. Now, why does this insanely simple exit rule work so flawlessly? First, it's actually simple to follow in real time. When real money's on the line, your heart rate spikes, your palms start sweating, you start second-guessing every little tick. If your exit strategy relies on 5 different complex indicators, you're going to freeze. This rule takes the emotion entirely out of the equation. Second, and most importantly, it naturally keeps your losing trades extremely small while simultaneously giving your winning trades the actual breathing room they need to maximize their run.
Which leads us to Section 4, the math of profitability. Let's look at why, surprisingly, losing is actually a massive part of winning.
Now, what's really fascinating about this data is a reality that might honestly shock a beginner. Based on the source data from months of testing this exact strategy, the win rate is only about 35%. Yeah, you heard that right. That means 65% of the time, this strategy generates a losing trade. Most people are conditioned since childhood to think that a failing grade means a failing system. But in momentum trading, a 35% win rate isn't just acceptable. It can be incredibly lucrative.
And the reason for that comes down to the sheer size of the winners. When you catch a microfloat stock on a massive news catalyst, you aren't aiming for a tiny 2% gain. You are aiming for an 80% explosion. If your strict exit rule, selling on the close below the previous candle's low, keeps your 65% of losers down to tiny, insignificant little paper cuts, you can literally afford to take a dozen small losses in a row. Because all it takes is one massive 80% wave to wipe out all those paper cuts and put you deep into the green. Over a 12-month profit and loss statement, the math overwhelmingly favors the disciplined surfer.
This perfectly encapsulates one of the greatest trading philosophies of all time. It does not matter how often you're right, it matters how much money you make when you're right, and conversely, how little you lose when you're wrong. Beginner day traders fail because their egos require them to be right on every single individual trade. They just want a high win rate so they can feel smart. But professional momentum traders, they don't care about their ego on a random Tuesday morning. They care about maximizing the big picture over the entire year. They maximize their winning trades by staying on the board until the wave is truly over.
So, as we wrap up this explainer, I really want to leave you with this final, provocative question to ask yourself the very next time you look at a chart. Are you trying to be a value investor in a momentum trader's game? If you're out there trying to buy the dip on terrible, heavily shorted companies, you are fighting a losing battle. But if you can learn to wait for the news, hunt for the low supply, buy the high, and strictly manage your exits, well, you just might catch the wave of your life. Thanks for joining me on The Explainer, and keep learning.